What's up, guys? I am nobody special. And last week's big sell-off in gold and silver following the Federal Reserve meeting was pure, unadulterated market manipulation. We're going to talk about how there was no valid macroeconomic justification whatsoever for that move we saw. You ready? Hit it. Thanks for joining me. My name's Jack Gamble, and I am nobody special. And the big headline last week was that the Federal Reserve announced that there may be 2 rate hikes before the end of 2023, which is a slightly sooner increase in interest rates than they had previously been forecasting. Now, apparently that passes for hawkish behavior from the Federal Reserve these days. First of all, let's look at just how absurd it is for the Fed to talk about what they're going to be doing 2 years from now. All right, think about where we were 2 years ago. 2 years ago, they had just made their first rate cut in a few years. They were talking about leaving the balance sheet where it was. In the following 2 years, they cut rates to essentially zero, and we saw the biggest period of expansion of the balance sheet in history. So the fact that the Fed could tell you what they're going to be doing 2 years from now is, on its face, ludicrous. Now, immediately following this announcement, we saw a huge move in gold and silver downward. Silver sold off from $28 almost in a straight line down to $26. And gold didn't fare much better. Gold went from the $1,900 level all the way down below $1,800. That is a huge move in gold and silver based on what was essentially a no never mind statement from the Fed. Now, the Fed did announce that they were going to talking about raising rates and talking about slowing their asset purchases. That is an inherently weak statement. Granted, it's a little bit stronger than what they had been previously saying, but they're still printing $120 billion a month and using that new money to prop up the housing market and prop up government debt in the form of mortgage-backed securities and treasury bond buys. And they're also going to leave interest rates at zero for 2 more years. Those are incredibly dovish policies. So the inflation we've been seeing is going nowhere anytime soon. So why would gold and silver sell off? Well, what we saw was it was almost instantaneously this sell-off started. I mean, it was purely algorithm driven. There was computer programs looking for keywords in the Fed statement, and as soon as they saw them, it started dumping paper. Now, keep in mind, I think very little physical metal changed hands, if any at all, based on this news. I mean, nobody saw this news and said, I better sell my physical gold and silver. They might raise interest rates by 0.5 point in 2 years. Quick, sell this metal. Nobody did that. It was a massive paper dump, and what they were doing was stop-loss hunting. And stop losses is when people put automatic sell orders into their futures contracts just in case the level drops to a certain point. So the bullion banks knew if they could take it down a little bit to below that threshold where the stop loss orders was, and they can see your stop losses. So they know when you have set to automatically sell. They knew if they could get down below the certain threshold where a lot of people had their stop orders, that they could trigger a snowball effect of a sell-off. And that's exactly what we saw. Now, part of this sell-off could be explained by a spike in interest rates. Right after the Fed released their statement, we did see a pretty good move of 4 or 5% upward in interest on the 10-year Treasury. So that could explain some of that sell-off. But if you look since, interest rates have come back down, and now they're actually below where they were before that meeting even happened. But gold and silver prices have not recovered. So if it was interest rates driving it, well, that thesis doesn't pass the sniff test because the interest rates came back down and the prices didn't recover. Now, you might be saying, well, Jack, gold and silver aren't really dependent on interest rates. They're dependent on real yields, right? Which is the interest rate of the bond minus inflation. Okay, let's look at that. Here's what real yields did in the days since the Fed meeting. And if you'll notice, real yields now, and most of the locations on the yield curve, are actually deeper in negative territory than they were on Wednesday. So again, this sell-off in gold and silver and a lack of a correction back up doesn't pass the sniff test because real yields would suggest gold and silver prices should be higher now than they were on Wednesday. Okay, so some people might be saying, Well, Jack, look at the dollar. The dollar has been a little bit stronger since Wednesday. That's true. If you look at the Dixie, the dollar went from about 89 on the Dixie to about 91, right? Okay, that's about a 2% move. But you have to remember what the Dixie is. And this is why, personally, I hate the Dixie as an indicator. Because the Dixie does not measure the strength of the dollar in terms of stuff. The Dixie doesn't tell you how much goods and services you can get for your dollar. What the Dixie tells you is how much other currencies you can get for your dollar. It's the strength of the dollar measured against this basket of other currencies from other countries. Now, you have to keep in mind what we have right now going on is this global contest of idiots to see who can abuse their currency the most. Because everybody in the world, all these central banks are printing money. They're all keeping their interest rates artificially low or in negative territory. And the dollar is no different. So the fact that the dollar is not coming in first place in this contest of idiots shouldn't really be bad for gold and silver. Again, it doesn't pass the sniff test because the dollar today buys you less stuff than the dollar did a few weeks ago. And that trend is going to continue. I mean, inflation is here. It's around 5%. It's going to get worse. So there's just no valid justification for this big move in gold and silver. It was pure market manipulation. Now, if the bullion banks were smart, they've used this opportunity and this price dip to cover some of their short positions, to go out and buy some of the physical metal that they need to protect against their short contracts, to protect against weaknesses in these unallocated storage schemes where they're selling paper claims on gold that aren't really backed up by any physical metal in a vault anywhere, at least no specific metal in a vault anywhere. But no, they didn't do that. And keep in mind, the Basel III requirements go into effect later this month. Under these new requirements, if you're selling a gold investment product, the net stable funding ratio means you need to have at least 85% of that backed by physical metal in your vault. Now, nobody really knows how much physical metal is stored in these unallocated accounts, but it sure as heck is not 85%. And the fact that these bullion banks have not begun accumulating gold, or at least stopping these unallocated storage schemes, it tells me that they have no intention of complying with the Basel III requirements. So I don't know what's going to happen when these requirements go into effect. Are they going to have some kind of a last-minute, 11th hour exemption written in? Are they going to delay the implementation yet again? Maybe. I don't know. But again, if they're smart, they'll use this price dip to buy up the metal that they need. Now, for us, there's really no effect, right? If you want to use this price sell-off to go out and buy more physical gold and silver, well, you may have noticed that the actual price of physical gold and silver is unchanged. As the paper price sold off, the bullion dealers just increased their premium to the point where the net price you're paying is unchanged. So that right there tells you that this sell-off was total baloney and that no metal is changing hands. So if the core of your precious metal investing strategy is to hold the physical metal, this dip does not affect you. If your investment strategy involves futures contracts or trading in and out of ETFs like the SLV, then this does affect you. That's why, in my honest opinion, it's always better to hold the physical metal. But this isn't financial advice. I'm not a financial advisor. Do your own research, do your own due diligence, and make your own informed decision for the benefit of yourself and your family based on your current situation and not what Nobody Special tells you on YouTube. So is this the last price smash we're ever going to see? Probably not. The bullion banks and the big banks have shown no changes in their behavior. There's no reason to suspect they're going to stop doing this. It's probably going to happen again. In the meantime, if your strategy is to buy and hold the physical metal, you're safe, you're protected from inflation, and you're protected from these price smashes. As always, thank you guys. I really appreciate you coming here. If you like this video, please like and subscribe to my channel. It would really help me out. And until next time, live small, dream big.